You've probably heard a million times that financial markets are supposed to be rational, logical, super efficient. But if that's actually true, then why do they so often feel, well, completely chaotic and unpredictable? Today, we're going to pull back the curtain and explore the hidden psychological forces that are secretly driving your money. And, yeah, the entire market. Okay, so on paper, the financial world is this neat, tidy place. All the economic models tell us that markets are rational, investors are efficient, and every single decision is powered by cold, hard data. But then you step into the real world, and the market we actually live in. It's emotional, it's prone to these wild bubbles and, of course, devastating crashes. So what's with the huge disconnect? And that right there, that's the big mystery we're going to solve in this explainer. If the whole system is built on a foundation of logic, why does it so often act in ways that seem completely illogical, almost human? So here's how we're going to break it all down. First, we'll question if markets are really rational or just random. Then we'll dive into the psychology of money itself. We're going to uncover some of the biggest hidden mental traps out there, see what happens when our emotions take over, and then, and this is the important part, lay out some smarter strategies. And finally, we'll take a peek at the future of finance. All right, let's dive right in. Section 1, markets, rational or random. So where's the answer? Well, it lies right here in Section 2, the psychology of money. And that brings us to the star of the show, behavioral finance. At its core, it's really the study of us. It just accepts the fact that we aren't robots. Think of it as where psychology and economics collide, and it looks at how our very human flaws, our emotions, our biases, all those mental shortcuts are what truly shape the financial markets. So, Section 3. What exactly are these flaws? Let's uncover the hidden mental traps that trip up even the absolute smartest investors out there. First up is the overconfidence bias. You know that little voice in your head that whispers, "Oh, I've totally got this. I can beat the market, no problem." That's it. It's this tendency we have to think we know way more than we actually do, and it often leads to trading way too much and taking on some really unnecessary risks. Next, we have something we are all wired for. Herd behavior. It's a deep-seated survival instinct, right? When things feel uncertain, it just feels safer to do whatever everyone else is doing. But in the market, that impulse can be incredibly dangerous. It's what fuels those massive bubbles on the way up, and it causes absolute panic selling on the way down. And believe me, this isn't just some abstract theory. We have seen this play out over and over again. Just think about the dot-com bubble, when people were throwing money at internet stocks that had zero profits. Or, the more recent cryptocurrency craze, which was mostly driven by a massive fear of missing out. And of course, the 2008 housing crisis, where it seemed like everyone just assumed property values could never go down. Every single one is a perfect example of the herd in action. And our third trap is a really sneaky one: anchoring. This happens when our brain just latches on to the first piece of information it gets, like the price you paid for a stock. We get anchored to that number, and then all our future decisions are based on it, even if the company's situation has completely changed. It literally stops us from seeing what an asset is actually worth today. But look, it's not just these quiet, subconscious glitches in our thinking that are at work. Sometimes our decisions get hijacked by something way louder and way more powerful: our raw, conscious emotions. Which brings us to Section 4, when emotions drive dollars. Let's talk about what happens when fear and greed decide to grab the steering wheel. This gets to a really powerful emotional trigger: loss aversion. Here's the deal. For most of us, the pain of losing $500 feels way more intense than the joy of gaining that same $500. And this fear of loss can push us to make some pretty terrible decisions, like holding on to a losing stock for way too long, just hoping, praying it'll come back. Looking back, you can see these emotional fingerprints all over recent history. The 2008 crisis, that was fueled by a toxic mix of overconfidence and herd behavior. The initial COVID crash back in 2020 was a textbook case of pure fear completely steamrolling market fundamentals. And we see it every single day in crypto volatility, where FOMO and panic can cause these massive price swings in just a matter of hours. Okay, so we know these traps exist. The big question is, what on earth can we do about it? That brings us to Section 5, smarter investing strategies. It really boils down to 4 key steps to regain control. First things first, just be aware. Seriously, knowing these biases exist is your first and best defense. Second, diversify. Don't put all your emotional eggs in one basket. Third, and this is a big one, define your rules before you get emotional. Set things like stop-loss orders or rebalancing schedules ahead of time. And finally, keep a long-term view. Try to focus on your actual goals, not all the terrifying day-to-day noise.
All right, and for our last section, let's look ahead. Section 6, the future of finance.
Because honestly, understanding all this stuff isn't just a nice to have anymore, it's absolutely critical. We now have AI that can scan social media to get a read on investor sentiment in real time. The huge rise of everyday retail investors has added a whole new, powerful layer of emotion to the markets. And the big institutions? They're finally building these behavioral insights directly into how they manage risk. So yeah, understanding psychology is no longer optional, it's essential. You know, when you strip it all away, it really comes down to this simple, powerful truth. Markets aren't some abstract machine. They're a reflection of all of us, of collective human action. And as long as investors are human, markets will always be influenced by our very human and not always rational tendencies. So we'll just leave you with this thought. Now that you know about these hidden traps, what's going on behind the scenes in your own head, how will you invest differently?